Well, we're seeing a little bit of a sell-off in the U.S. bond market right now, but it's coming off of a tremendous November where we saw yields come down. Remember, yields were careening towards 5% before hitting that and coming right back down to 4.2%. Much of that just happening in the span of a few short weeks. This, as the Federal Reserve does still say that a hike is on the table. It will tighten again, but our next guest says it's becoming harder for the Fed to convince markets that it will tighten again. Gennadiy Goldberg is head of U.S. rate strategy at TD Securities. Gennadiy, it's like when I'm threatening my kid that I'm going to take away her iPad. She knows that I'm not actually going to follow through with that. And it feels like that's kind of the market's thinking right now when it comes to the specter of another rate hike.
That's exactly the case. I mean, at this point, the Fed is on track to deliver a third straight on hold message. And in December, the big question for us is how are they going to paint 2024? You know, they've got some cuts penciled in. Do they take that out? Do some of them threaten that there may be more hikes on the table before there are cuts? I mean, the possibilities are really endless, but these markets are just not buying it. You know, just like your daughter, it's going to be tough. You know, how do you actually threaten the markets efficiently? So
we've been here before. We've walked into January before thinking one thing about rates, and the Fed did successfully take away the iPad, as it were, teach us a lesson. It really does seem, though, that, investors are thinking this time is different. Broken clock is right at least twice a day. This time they will be right on this dovish pivot.
I think so. I think really it all boils down to the data. If you continue to have strong data, then certainly, the markets will be proven wrong. What we're seeing right now is the surprise indices, both in inflation, hard data, soft data, wherever you look, are pointing to the downside. So data has been surprising to the downside. If it starts to surprise a little bit higher, I think the markets could be in for a reversal. As you mentioned, we've had, that November to remember in the bond market. We could certainly have a reversal of at least part of that, but I think it's going to be hard unless the data turns very decisively one way or the other. It's going to be difficult to see the kind of the broad direction. What we're looking for is data to turn once you actually get into early next year, but just not yet, not to this extent.
I'm wondering the relationship between the bond market and oil prices. We just had the energy minister of Saudi Arabia say we could cut production again into first quarter. Oil prices move higher. You see that kind of sell-off in the bond market because rising oil prices is inflationary. Are you seeing that kind of tight link and relationship in the bond market right now?
So I think the bond market right now is struggling between really two factors, and I think this is going to be the theme for 2024. It's supply-demand imbalances versus the macro. And if the macro wins, and then certainly rates will go lower. On the oil side, I think oil is also struggling with that same theme as well. I mean, if you've got oil actually moving lower because of expectations of lower growth globally, then you could see the two move in tandem lower. But certainly, if oil spikes on demand, and if demand actually comes up, then that could push inflation a little bit higher, could make the Fed's job a little bit tougher.
What are you advising clients right now in terms of the most likely path of rates for the year, and acknowledging that it is kind of an art on calling where these things are going to go, but directionally you have a sense?
Yeah, so directionally speaking, we're long tenure treasuries. We still think long duration makes sense. We have a recession call penciled in for the U.S. By June of 2024. We expect the first rate hike by June 2024 as well. So we've got a kind of a Q2, Q3 recession next year. So I do think the direction of travel is going to be to the downside, but it's not going to be a straight line. It almost never is. And when you have these very large swings, these massive market repositionings, it makes it very difficult for investors to position because they're always kind of late to the party one way or the other. I think being patient, being long, listening very closely to the data, right? If the Fed can be data dependent, so can we. But we still think lower rates into the end of next year is the base case.
So long U.S. Treasuries, how far out into the risk spectrum are you going? High yield has had a huge rally from those October lows.
So what I'm a little bit nervous about is this lack of pricing in spreads or in both high quality and high yield. Both of those are extremely tight with these levels. I think this market is almost perfectly positioned on the head of a pin for a soft landing. And if that doesn't prove to be the case, if you start to actually get some weak data here, one of these markets is going to be proven wrong. You've seen both equities rally and rates basically rally. And now when you see sell-offs as well in both directions, one of these markets will be proven wrong, and it's going to be quite painful. And, our view is you should be very careful about the risks you take on in spreads.